All right, good morning, everybody. It's Monday, not Monday, right? You know how it goes. Japan knocked the world over. You feel it? Hopefully, you got those put lottos that we talked about last week. Feather out of them through the day because this sort of stuff could turn around in the blink or it can linger for a while. So don't completely get out of your position, but make sure you lock in some gains on this drop because, um, it can change, right? So we're seeing a little bit of weakness from that. We got Davos kicking off this week. Um, there's not a whole lot on the schedule today. If we're just looking at the Market Watch calendar, they always go for the big stuff, right? And they don't have anything. Let's see. I updated the YouTube description. It's not done yet, but I did put in some of the charts that I use for TradingView. So do me a favor, go over to the YouTube, like and subscribe, get the charts for TradingView if you're using it over there. Help me with that channel. I really want to grow it out this year. It's something that really I should have done a long time ago, and I just didn't. And yeah, I'll continue to add more to it as we go. There is some issues with that, right? So just real quick, TradingView has limited information when it comes to options data. Now that's changing because they are linked now with Tasty Trades or Tasty Live, whatever you want to call it nowadays. So in 2026, I expect a lot from TradingView. I think they're really going to explode this year when they finally fix this hole that's been missing in their platform for a long time. A lot of the tools that I use on Thinkorswim rely on options data, right? The weekly expected move and that sort of thing, the market maker move. Without that options data, we can't have those tools. So I don't have the ability to put every one of my charts on TradingView since TradingView is missing some of the data needed to replicate my Thinkorswim charts. But for most of my charts, I have been migrating them over to TradingView. That way, you can use things like the ADR, the CPR, the 65-minute profile, 10-day, 30-minute profile. They're all built. I just need to get them migrated. You'll find those chart links in the YouTube description. All right. Eventually, I'm going to have to open up a TradingView workbook very similar to my Thinkorswim workbook, which will just be an entire Discord loaded with TradingView charts, studies, watch lists, columns, all that good stuff. That's what I was doing this weekend. What y'all did this weekend? Hopefully something funner than that. Today is my brother's birthday. Yeah, I know you guys can't see yet. I was hoping to link this issue. Um, Today's my brother's birthday, so for those of you who know me on Facebook, follow it over to his page, right? Just tell my brother happy birthday. He's old. He's like old. So he seemed kind of bummed out when I was talking to him. Maybe we could cheer him up a little bit. I don't know what we're gonna get out of Davos today. Remember, it's all week too, right? We're gonna hear just shenanigans, crazy stuff. I wouldn't read too much into it. Friday is likely gonna be the big day, anyways. We'll see what we get out of it. Next week is FOMC. The call wall rolled up into new highs, and the put wall rolled up, and then we broke it. So that's fun. Remember, when we get radical changes to the existing narrative, that's a good word for it, you want to come over and take a look at the Fed Watch. So this is the CME Fed Watch. It's free. It doesn't cost you anything. If you just Google Fed Watch, you'll find this. Bookmark this page so you can come back to it. You don't need to stare at it all day. Just stop by once or twice a day, especially if we get news that changes the narrative, and see if that new narrative is being priced into the market. When I was newer to trading, I'd hear people say things like, "Oh yeah, they had that priced in," or they're unwinding a rate cut, and I would always wonder, how the hell do you know that? Where did you see that? How? I don't get it. Well, this is what they were talking about. So, if you want to know if they're pricing in a rate cut or they're unwinding the priced in rate cut, this is where you would see that at. So, cheers, right? Come over here, keep your eye on it. You don't really need to worry about the later part of the year, September, October, December. Those aren't our focus. And of course, the one in the very front, it's already locked into stone, right? That one's not moving. So don't worry about January 28th. Focus on March and April. Maybe a little bit of June if you're looking at some big picture stuff, but mostly March and April. All right. So if you're not used to reading this, just pick one of these numbers just to make your life easy. Right. Uncomplicate things. We'll just say we're at 350. So when you look down here, do the same thing. Just look at one number. This is where we are at right now. If they were to cut, we would go there. You can see there's nothing scheduled for raising rates because why, right? Well, why would we? Then you can scroll down and you can find the same thing. Scratch out that one number, keep the other one. This is us. This is where we were yesterday. This is where we were a week ago, and this is where we were a month ago. So if they're pricing in a rate cut, then we would see this number go down, and we would see one of these lower numbers go up. And between yesterday and today, looking at the March FOMC meeting, it barely went up a minor amount, just barely. But it all starts somewhere, right? For those looking for a rate cut, that is the first little wink that the market is starting to price in a rate cut. If you remember how it went last year between, say, September, October, November, December, with the ups and the downs, and we laugh and we cry, and it was just all violence and craziness, that was the market pricing in a cut and then unwinding it and then pricing it back in again. That was fun, right? Like roller coasters. That sucks. And that's why we would rather just be in an environment where the Fed is providing forward guidance and we already know what they're going to do in advance. And then we don't see the market pricing in and unwinding and pricing back in again after every new headline or after every new speech where somebody's out chipping their teeth on something. Well, I was hoping they would be ready, but I guess they're not ready. All right. Fine. CTA positioning is still above zero. They are continuing to de-risk a little bit, but not at an extreme pace. Something to keep our eye on, right? And the change looks a bit like this, which, provides a little bit of hope. And this is the projection. So if the S&P continues to unwind, this is very likely going to be their baseline decline in positioning. And if the S&P stabilizes and tries to rise, then that would be their baseline positioning. Yeah, you don't do that. You just shush. weekly. All right, I got this chart shared over to uh, the YouTube. It's in the description. Looking at it, I just realized I didn't add the VWAP. So maybe I'll redo that and put the VWAP in it. This is a midnight VWAP, by the way. I just got a question on this, on where was my VWAP. And um, in the last month, I've had this conversation now with multiple people. So I'm not picking on anybody when I say this. If you have more than one broker and the indicators don't line up on those different brokers and you're struggling, stop struggling. The brokers have never promised to meet up and match and synchronize their indicators, right? So if you're on TradingView and Thinkorswim or TradingView and Tradeovate and your VWAPs don't match or your moving averages don't match or your MACDs don't match, they're not supposed to, right? If you've done any math before, then you know that where you start really matters. And if TradingView starts their math 8 years ago and Tradeovate starts their math 8.5 years ago, the starting point changes the entire calculation. Now, I'm not saying that they'll be, you know, 15 points off, but your brokers are under no obligation to match, and they don't care what their competitors are doing. They're not going to try to synchronize their systems. So work with what you got. When it comes to these VWAPs, um, Peter Resnicek made a great argument for why a midnight reset VWAP is a better choice than a 6 p.m. reset VWAP. Once you get into the middle of the day, it really doesn't matter. I've proven that over and over and over again. But if you're like me and you do a lot of trading in the pre-market, it kind of matters. You can see a significant difference in VWAP if your VWAP resets at 6 p.m. versus resets at midnight. So really, it just depends on what kind of trading you're doing. If you're never trading in the Globex, then it doesn't matter if you're using one or the other. And if you are trading in the Globex, try them both and see which one you like better. So we're back above VWAP this morning. We are still underneath the 10-week moving average. We can see this 10-week moving average here on my 15-minute chart, right? I built that same chart in TradingView. That way we don't have to come out here and look at the weekly to try to find out where that weekly line is. Simple system, right? I have made these indicators for Thinkorswim a long time ago. I called them TrendSpider moving averages because when I built them back in the day, TrendSpider was the only platform that I knew of that offered multiple time frame tools. You could be on a 15-minute while looking at a daily RSI, for an example, right? So I built those kind of tools for RSI, MACD, moving averages. I think it was really cool. Nowadays, just about every platform can do that. But back then, when I was making them, there wasn't a lot of platforms that did it. So if you're looking in the Thinkorswim workbook, try to type in the word spider in your search bar, upper right side of Discord, and see if that'll help you find those indicators. Thinkorswim has a default moving average that'll do this, but it's an SMA and I wanted an EMA. So we're still underneath the 10-week EMA. Of course, we're under the 3-week. And that puts us underneath all of the daily moving averages as well. 3, 10, 20, we're underneath all of it. We're also now below the zero gamma. We're likely below the put wall. Right there, there's the put wall. Volatility trigger. And we're far enough below zero gamma that we should see the dealer positioning behavior as if we are in a zero gamma environment. That's not always the case, right? Sometimes we can just barely get below, and of course they won't respond the same way as if we're thoroughly and completely below. We do need to see how the day goes by. It's likely we're going to see the put wall get rolled down. The question is going to be, how far down is it going to roll? 6750, 6800, maybe a split somewhere between those two. That positioning should show up through the day today, so just keep your eye on what's getting hammered out in the options flow. Now the cumulative overnight volume on TradingView is not exactly the same. It's a little bit better, and then it's a little bit not better. So they got the kill zone kind of marked out. It's not the real kill zone, but it'll do. They got that bump through, right? Which is really cool. I like that. That got me thinking that we could do something like that for the kill zone with the Thinkorswim version, right? That would be nice to have that as a separate, what these are called Schwab bars or histogram bars. The kill zone is between 2 and 4. So, you know, Tokyo closes, London opens, and then, 4 a.m. That's usually the unwind, right? Half the time, that's my trade. Either trading it back out, because I don't get up at 2 a.m. to trade. That's crazy. But I'll trade the reversion back to the mean. In this spot this morning, we just went back to the 2 a.m. move. We're at the 10 week, so we could stick there for a little bit. It can act like gravity. But on the other hand, we've reached the ADR, and we did it early enough in the day that we could go to the other side by the end of the day. I know you might hear that and think bullish, but that's not bullish. That's just price in wave form, right? Price isn't going to move in a straight line most of the time. It's going to pull back and push ahead. So we made the lower edge of the wave. It makes perfect sense that we would now hit the upper edge of the wave. And if we get to one side early enough, a lot of times we go to the other side by the end of the day just because that's what we do, right? Just come out here and look, right? That's what we do from one side to the other. Even if we rotate everything and we're headed in a downward direction, or if we're headed in an upward direction, it would be the same thing because that's what we do, right? So don't get hung up on the idea that we're looking at 69.47, just round that up to 69.50, or even 69.80. That wouldn't be bullish. That would just be the other side of the wave. We've got a very narrow ADR. It's less than 60 points for the average daily range. This is the first day of true violence we've seen in a while, right? The S&P was down what, 1.6, 1.7. The Nasdaq was down more than 2.0. That's a pretty good move on the day, and we're already unwinding that significantly. It's likely not going to stick, right? But if it does, we'll expect the ADR to start to climb, and if it gets, above 85 or 90, then we know we're truly back in a violent environment. But we're not there yet. This is just some little blip in the radar at this point. A flash in the pan. Isn't that what they say? All right, CPR charts. That one was really easy to replicate in TradingView. It's just a weekly footprint and a daily footprint, right? So these are your floor pivot levels with a floor pivot channel, which is why it's called a CPR. And we've got the daily and the weekly. So on the week, we are below both. That's bearish. This week's weekly floor pivot is higher than last week's. That's bullish. We opened underneath it. That's bearish. They kind of cancel each other out. And then our daily floor pivots. Today's opened a little less than yesterday's, but price opened significantly below it. That's bearish. It's a narrow channel, which implies breakouts stick and we keep it. But this is a broken environment, so we'll have to see how it plays out. How far away we are from these pivots really matter, right? Now on the week to the downside, you can get 4 to 5% away from that weekly pivot before you need to worry about mean reversion and coming back in again. But going the other direction from the daily pivot, you shouldn't get that far away without having some sort of mean reversion. So what we want to focus on today is the S&R lines. This system is not a perfect system. It relies on the previous day's price action to help formulate where the levels are going to be today. And unfortunately, because of the holiday and that broken shunted price that we had, there was not a lot to read, which is why the range is so narrow, right? You can see how it's so narrow. Now, we've been moving considerably today, and if you look at the projections for tomorrow, I mean, just look at those projections for tomorrow. Today's entire range would fit into R1 and S2. So, when you have a big day today, tomorrow's levels will be really wide. Our levels for today are not very helpful because they're based on that broken day's data. Still, we are facing S3. If we can get above it, we want to target S2. And then, of course, if we can get above that, S1, and then back to the floor pivot. There's a gap here that needs to be filled. So it makes sense that we target Friday's close. But we'll run it one thing at a time, right? Get through the half back of all this, then get to the top, break the top through the gap, and go for Friday's close. When it comes to holidays, I always tie this data to this data. So as far as I'm concerned, all of this is Globex. And that's how you want to measure it. Mark your halfback from all of this. Don't try to separate it into Monday's price and Tuesday's price. That's going to mess things up when it comes to profiles, but it's all right. So the halfback, 68.90, just round that to 68.92 cog line, lines up really well with this S3 that we're negotiating. Get through the half, make it to the top, check Friday's low, and then finally we'll get to Friday's close. If we fail, or if we're going to fail, it is more likely to happen right here on the half than anywhere else, right? So if we're going to roll over and keep going to the downside, I would look for this level to fail. We can get above it and then not keep it and come back in. So keep your eye on it. If we do get above, that's your line in the sand. Across, back, down through that level would be a continuation of this move to the downside. Otherwise, once we get above and we're holding it, target those upper levels. All right, I've got this mid-December contract change profile marked. It looks like we ran right through that without even slowing down. It is the value area low for this morning. We've got 6901 overhead for the current point of control. Distribution's not all that fantastic yet this morning, but this is the higher time frame. There's not a lot yet, right? This holds 5 days worth of data and we don't even have 1 day yet. So, let it fill out some. To the downside, that was the last profile point of control that we had of value until all the way down here. Now that's 6780-ish, right? Just looking for some round number. The last time we got down there, we saw a response. So if we do break 6850, we're going to 6750 with a possible speed bump right there at that 6780 area. $10-day, 30-minute volume profile in TPO. We are working on the current point of control. The candles that made this point of control are going to start to get erased today, right? For every new candle that we get on the right, we're going to take one away from the left. But I doubt that these are going to be enough by itself. So maybe by the end of the week, we'll have a new spot for this point of control, or we hang out in one particular spot, let's just say 6,900, and we build that 69 out fast enough to move this down without wiping those candles out, one way or the other. Right now, we're not expecting that point of control to move anytime soon, at least the week. So that just leaves it as a significant resistance over our head that needs to be dealt with. The good thing is, if we do make it back up to the top of this zone and we get inside this channel, then once we're in that channel, it's more likely that we will begin to gravitate to the upside. Is it going to be enough? Probably not, right? By itself, that I wouldn't trust that to get me back where I needed to go. But at least it's not a resistance, right? It's not a, how do I say that? It's not drag or headwinds. So yeah, at least it's that. All right, this is the 5x5, and it's a tricky situation this morning. When it comes to technical analysis, you want to run as consistently as possible. And when you run into situations like this, you want to make sure that you handle them the same way every time. If it's the first time you've had the situation happen, then, do a thorough report, try to figure out how you want to manage the situation so that if or when it happens again, you can refer back to your notes. So what am I talking about? We jumped this point of control. Now, technically speaking, it's still not touched, right? This is a VPOC. It's an untouched point of control. And the fact that we jumped it without hitting it means it's still an untouched point of control. The fact that we're lower than that level is where the argument comes in. So, do you leave it on as a VPOC, even though we are now underneath that level, or do you take it off because we are now underneath that level? Me, I resolved this a long time ago. That line has not been hit. I marked that line because of the traders who put in all that work back here. It was the greatest amount of trading on that day at that price. The expectation is if we go back to that level, that there will be elevated trading activity and I wanted to know where that level was at, and to make sure I didn't forget, I marked that line. Well, that still holds true. I still want to see the behavior at that level, and I want the warning or the heads up. So I want to leave that line there. Now, you can, you know, if you are using different line types, then of course you could adjust the line type or the color to remind you that this one is different, that it's not the same as your regular line. Just to give you that extra awareness that, yeah, this is still a VPOC level, but it's different than our normal VPOC level. We do want to wrap all of this together. So as far as I'm concerned, all of this should be under one profile. Since the volume profile is going to reset after every day, then that doesn't work for me, right? It's still breaking these apart. And even though this one's on the right, it would be the easiest one to change to just knock it to a 2-day profile, and it would expand to capture that. That's what I would recommend you do if you want to put these two together. I'm not that worried about it. Visually speaking, we can just tie it all together. And if we did that, then 6900 and 6911 are significant levels of interest to me. And they're, especially since they're over our head and we're moving in that direction, that's what I'm going to focus on, right? To the downside, it wouldn't matter because none of that existed down here anyways, right? So if we start to break back down, just focus on this point of control down here. I know, Captain Obvious stuff, right? Okay, it's hard to see this unless I really zoom in, but we are here. And there's just a tiny little toenail down there. So we are just under the 10. I wouldn't get hung up on that. I'd say we're at the 10. We needed a reset. I talked about that last week, how we could get another dip down like this before a run back up. And I'm still looking for new highs here. I've been looking for them, since since all the way back here. We keep setting these lower highs and lower highs. I thought we were going to get something here, and that just didn't work out. What a tease. So I'm looking for a really good breakover and a 3.5 to 4% move to the upside. That's 3.5 or 4% above the 10-week. The trick about trying to get that far away from the 10-week is it's a dynamic tool. It's moving at us at all times. If we're underneath it, it's trying to move at us downward. And if we're above it, it's trying to move at us upward. So we have to not only make our move for the day, but we have to move further than it moves if we want to outpace it. We're at the 10-week. This is a bit of a calm. Time and sales and trading volumes and trading activity change when we're at or around the 10 like this. The 10-day, the 10-week. It's an odd thing, but if you're used to reading the flows, you can see it. So this is like it's like the calm in the center of a big storm, right? We're in that calm. Once we leave it, then we're back in the chaos again. And we talked about the weekly expected move last week and how things were a little off. We knew some violence was coming or that the market was pricing in a threat because the width for this week was greater than the width of last week. Right? So this is our new week. This is last week. Our current week is bigger than last week's range, and yet our current week is a 4-day week. So these ranges are built based on volatility and time. If we had a 5-day week last week and a 5-day week this week, and we saw this sort of difference, we'd say, oh, it was just volatility. We have more volatility this week, a little bit more. But this is a 4-day week compared to a 5-day week. And it's not a little bit of volatility, it's a lot of volatility. There was so much volatility priced into this week's 4-day week that it spread the width wider than the previous week. So they already knew that something was a threat and was pricing it into the market, and they knew it wasn't your typical economic event. CPI, PPI, non-farm payrolls, those are volatility suppressing. It would have made our week narrower and we would go into a hurry up and wait mode. That's not what they did. They widened the range so they knew there was a threat and they knew it wasn't an economically scheduled risk event. And they nailed it too, by the way, because look, we got the expansion. We traveled all the way to the edge of the weekly expected move and breached it. Now we're back on the line. That red line was the projection of how far we could move by the end of the week. We made that whole move in a day plus some. So, yay, we're back. We're there. Let's get into the box and we need to keep it, right? One day doesn't mean anything, but at the end of the week, we do want to close inside this box. And then we got the door, right? That's day one open range, DOOR. Well, there's your day one. I gotta say though, when it comes to the door, that works better on equities than it does futures. But it's already there. I might as well point it out. We're back in the door. And a lot of people use a 3-day instead of a 1-day. You'd still use it, the acronym DOOR, but you would mark all 3 candles. It's just another open range program, right? Who knew they had a daily? I did, because I read too much, because I'm a nerd. Speaking of daily, this is our distance from the 10-day moving average. We are more than 1% away from the 10-day. So first, we need to get back inside that 1% window, and then 2, get back to the 10, and then get back above it. The question at this point is the reversion. Is it going to be a 1-day wonder like it is back here where we just dipped down 1 day and then we reversed? Or here where we reversed? Or is it going to be more like this where it's a sustained travel and then finally we turned it around and reversed? Right? It can last for a while. Or it can just be these little 1-day wonders. That's what we're hung up on at the moment. What's the scenario here? And considering how fast we've already started to unwind all of this, it's likely that it's just a 1-day wonder. But I'm looking at that percent change and it seems to be growing again, right? Yeah, a little bit. We rejected the 10 week. Imagine that. Who'd have known? Also, it looks like we're getting a little bit of reciprocation here. Oh, it's not done. You owe me a little bit. Give me my stimmy. So it owes us a little bit more. We'll see if we get it. Hopefully it doesn't cheat us, right? All right, so what's down today? Everything. Let's look at the other way around. What's up today? What's up? The Mag 7 down volume is up. Always helpful. The VIX, surprise. Hey, is the VIX in contango still, or have we slid into backwardation? That's like sliding into your DMs, right? No. All right, the easiest way to see if we are in backwardation or if we're still in contango is to just use the VIX futures on Thinkorswim because it's got the dates and the price, and you can see. Ignore the 1 day because we're about to swap to a new contract. Just focus on this next contract out, which is February at $19.55. And if I scroll out, the numbers are rising: $20, 2060, 2080, 2090, 2150. They're getting bigger. So we're still in contango. It's all good. Things aren't that bad out there, or we'd see the VIX flip, right? And we haven't seen the VIX flip into backwardation, so all's good in the hood. That's simple enough, right? You know what I'm talking about, right? You understand the words that are coming out of my mouth? Uranium's up, gold miners, nat gas. Good morning, Nicole. How you doing? Did you have a good weekend? With this much breadth, so negative, it should be a very clear turnaround if we did get a turnaround, right? Like it should be a rising tide that lifts all boats sort of scenario. So on that side of things, if we are going to turn around and head up, it should be really easy to see. You know those kind of days where it's choppy and nasty and violent and we just grind higher anyways, kind of like those forced buy days? Those are not always fun, especially when you can't see the why behind it, when we don't have any breath behind it and it just keeps going up anyways. I don't think today's going to be one of those days. If we do get a push to the upside, I think it should be very obvious, and we should have the backing of all of this stuff that's down. But also, don't let all of this stuff fool you, because when the S&P and the Nasdaq move, it doesn't have to be because of breadth. So even if it all turns around and starts to go up on its own, that does not mean that the S&P and the Nasdaq is going to go with it. Most likely it is, most likely, because that's what we would expect, but doesn't mean it has to. All right, so let's finish it up. Short and sweet, to the point. You got to get out of the box, as always. Always, always, you got to get out of the box before you do anything else. Right now, the current box is the Globex, and I would treat all of that as the Globex. So catch the mid, get through that, and keep it. Just ballparking the mid here. That's close. Once you get through the mid, make it to the top, close this gap, and target the close from Friday, right? Along the way, you've got Friday's low, and then you've got the close of Friday. So you got some levels to focus on. It's real easy to the upside with these levels in play. It's just destination trading, right? To the downside, break our own Globex low. Try for a 111 and a 1236 down here. See if we can, trap some bears and run it back the other way. After that, we want to run the continuous dynamic fib lines, right? So that we expand our drawings with price as it falls. Round level targets would be the 50s. So underneath 68.50, we target 67.50 with, of course, speed bumps on the cog lines, 11, 32. You get the idea, right? 92. Simple, simple. So what I got for you guys, be careful, be safe, have a good day. I'll see y'all tomorrow.